Well, welcome. Sorry that we don't have enough seats. Believe it or not, on campus, it's always complicated to find an auditorium that holds enough students, but it's great that we've got such demand for this session. It shows that we've put together hopefully a good panel out here. Obviously, it's quite an interesting time for us. It was 1 year ago today that we saw the collapse of Lehman Brothers, and certainly the days and weeks that were leading up to that saw a lot of uncertainty in the financial markets. We know what the last year certainly has provided to us. I remember at the time actually leading into that Monday where Lehman Brothers fell last year on September 15th. That weekend we had a parents' weekend here on campus, and we had a number of folks from the finance sector and accounting firms and so forth. And I remember walking around that Friday night talking to them, and I have to say it was one of those times where you really kind of felt the fear. You know, there was a lot of uncertainty in the minds of people that were working on Wall Street, a lot of concern about what could possibly happen that weekend. In fact, that night I went home and I called my mother and I said, where's all your money? And I think she was more worried about me, frankly, than she was banks failing at that point. But it really was a time, just a year ago, that there was a lot of concern. Certainly over the last year, there continues to be a lot of uncertainty. We're still not sure where all of this is going to lead. We seem to be a little bit more confident, obviously, than we were at that time. But for us as an academic institution, it really has provided a time where a lot of, I think, very positive lessons are to be learned. There's still a lot of chapters to be written and books yet to be written. We don't really know all the answers, but it does seem like an appropriate time, especially given the interest amongst our students in the finance, accounting sector, people looking for jobs right now, obviously. A good time to look back on what's happened this past year and to see what the lessons learned going forward might be. And so we're very honored today to have a distinguished panel, which Dr. Mao is going to introduce to you in a moment. I want to thank the group for being here today. We're very much looking forward to hearing from them. And so I'm going to turn the microphone over to the chair of our econ department, Dr. Wen Mao. Wen?
Hello, everybody. You here? All right. As Jim was saying, this is certainly a challenging time for our economy, our businesses, domestically and globally. We certainly did not lack material in the classrooms, for sure. So it's an exciting time to be in a business school at the same time. Unfortunately, most of the discussions we have are around lessons learned as opposed to something more cheerful nowadays. But the way we handle the crisis will be written into history books. And how we continue to shape up our legislative system around the financial institutions would also be written into history as well. So it's a very exciting time for us. VSB actually had a similar panel earlier this year in the midst of the financial crisis to help our students and communities better understand what caused the problem. It was in February, I believe. October and February, actually 2 panels. So it is particularly meaningful today at the anniversary of the fall of Lehman Brothers that we get together again to discuss lessons learned in the past year. It's a great honor and privilege to introduce our distinguished panelists. First off, to my right, we have Mr. Jack Brennan, the chairman of Vanguard. He's also a member of the board of directors of each of the Vanguard mutual fund. Mr. Brennan joined Vanguard in 1982. He was elected president in 1989, served as chief executive officer from 1996 to 2008, and has been chairman of the board since 1998. Next to him in the middle, we have Mr. Terry OToole, who's the co-managing member of Tinicum Capital Partners, a private investment partnership based in New York City. Prior to joining Tinicum in January of 2006, Mr. OToole spent 21 years at Goldman Sachs, where he was a partner, a member of the investment committee and the partnership committee, and the chief operating officer of the principal investment area, the private equity investing arm of the firm. Mr. OToole received his undergraduate degree from Villanova in 1980 and his MBA from Stanford Grad School of Business in 1983. He's the vice chairman of the board of trustees at Villanova. And Further to the right, we have Mr. Charles Ellinwood, who's the managing director with Barclays Capital. He's a member of Barclays Capital's Public Finance East Regional Group with responsibility for the Mid-Atlantic market. He has worked in a variety of areas in public finance throughout his career and has completed over $20 billion of tax-exempt and taxable bond financings relating to transportation, education, healthcare, higher education, infrastructure, pollution control, and industrial development projects. Prior to joining Barclays Capital, Mr. Ellinwood was a senior managing director in the public finance department of Bear Stearns. Now, I hope I won't steal your punchlines here, but this is too good to pass. I must point out that after the fall of Bear Stearns, Charlie actually took on another job with Lehman Brothers. And he stayed there for a month, and then I'm sorry. I have no doubt he's going to work at Vanguard. I have no doubt he's going to share towards the end some of his personal experiences with him. As I told my class right before this, he has a Villanova degree from history department, so he's going to be prepared well for the adventures that he will have. All right, each of our panelists will take about 12 minutes to offer their thoughts and insights, and after that, we'll have about 4 minutes for the other two panelists to comment. Towards the end, we'll open up questions and comments from the audience. So you should have about half an hour towards the end, plenty of time for you to ask all your questions. All right, without further ado, let's first hear from Mr. Jack Brennan.
Thank you, Dr. Ma. Thank you. Good afternoon, everybody. I was disappointed to find out you're getting class credit for this. So we thought it was us who attracted you, and one of your colleagues ratted you out. But that's okay. My kids would do the same thing at Notre Dame. It really is. It's great to be here, and it is a great chance. And I commend you for sponsoring this forum, because it is a great time to learn and learn lessons. And you know, it's hard to imagine it was a year ago that Lehman Brothers went down and all of what went on. But I tell you, I actually, in my role in the mutual fund industry, think about it being a 2-year anniversary, actually, because much of what culminated with Bear Stearns and Lehman Brothers was visible, far more visible with hindsight than foresight, a year earlier, when Bear Stearns had 2 hedge funds that went bad. You could argue that those were the canaries in the coal mine at the time in June and July of 2007. And then much, if you look at charts and if you look at what was going on in the marketplace, foretold what would happen. But most of us, regulators, investors in the markets, didn't see it and couldn't see clearly what was going forward. And I think there's a lot of lessons in that alone. When subprime hit the headlines back in 2007, the scale of the problem was thought to be something like $500 billion. That's how deep the hole was thought to be. And now the number is closer to $2 trillion and growing. So really smart analysts missed it by a factor of 4 and maybe more as we looked forward from there. Obviously, it all came to a head a year ago, and as Dr. Mao said, it's a tremendous chance to be a student, and frankly, I think it's a tremendous privilege to have been a participant in this. You know, not fun, but a great if you want to learn and grow as an individual going through the past year and what's gone on. It's been a tremendous opportunity to take advantage of that. So I'm going to share with you just 6 quick lessons. There are 600. And I've picked 6 that are high-level lessons as fodder for us to talk about. They already said they're going to disagree with everything I said, so I'm getting ready. But and there are 6 things that I think that you can look back over the past year and say things that really matter, and they matter in the sense the difference between winners/survivors and losers. And the first one is leadership matters. Leadership matters, and you know, if you look at, I would argue, the single biggest differentiator between the firms that survived and even thrived, and there are many firms that have thrived through this period of time, and those that suffered, needed to be bailed out, or failed, it's leadership. Not just an individual, but leadership at the corporate leadership level, leadership at the board of directors level. And leadership which created cultures which were sustainable and long-term rather than expedient and short-term. And I won't go through naming names in a public session, but you can just go down the list and think of the firms. And the leadership at the top, the consistency of leadership, the strength of the leadership, the ability to look through the near term, to think about the long term, was a tremendous differentiator. And those that are surviving and doing very, very well today almost invariably have strong, consistent leadership, and weak leadership led to other outcomes. Similarly, from a leadership level, a culture about the firm, not the individual. Tremendously different trajectories of success. If the 15th floor managed for the 15th floor and the 16th floor managed for the 16th floor, that firm may not be here today. The firms that managed for the firm, because they had strong leadership, were the winners in that. So leadership matters is number one. Number two is prudence matters. You know, when markets are roaring and everybody's making money, prudence seems a little old-fashioned in many ways. You'll hear more about this from Terry, but the worst example of lack of prudence was the extraordinary amount of leverage that got put into the system. You know, imprudent is the definition there. The math of leverage simply doesn't work when times get tough. It doesn't work at times. I was riding home from Cape Cod with my wife, who's in the academic world, not a business person, in the summer of '07, and she says, "I just don't get this leverage thing. Can you explain it to me?" And she was just observing the kind of numbers that were out there and hearing about them. And obviously, a lack of prudence proved lethal for firm after firm after firm, some well-known, some not so well-known. A prudent strategy for a financial business is a long-term viable strategy. Third thing is simplicity. And simplicity may be strategic, and it may be product structure, it may be a whole bunch of things. You know, the old adage that you've heard 100 times that if it seems good to be true, it is. And it was proven again and again and again and again. And whether it's, you know, leverage inherent in structured vehicles, whether it's the packaging of poor credits into what were theoretically good credits, or the fact that AAA could be all over the place from a rating standpoint because of complex structures. The fact of the matter is, if you look back and say which investment strategies served people best over the last cycle, not just the last year, it's the simple investment strategies that did. Targeted and focused, whether it's a hedge fund, a private equity fund, a mutual fund. They work best for their clients. One of my good friends, Richard Ennis, runs a terrific investment consulting firm, and at the end of the year he had a sort of thought piece, and he said, if you don't understand the underlying thesis of an investment proposed to you as a professional investor in 5 minutes, take a pass. It's a compelling lesson. We've known it our careers. People forget it in good times. The fourth thing, and you're hearing a lot about this today, you saw it in the New York Times if you read the Times, is about regulation. And in-touch, knowledgeable, experienced regulators matter. They really do. You know, when you look at the cumulative effect that led to the events of last year, clearly there's culpability in the regulatory community. There's culpability in the regulatory community. And the fact of the matter is, in my opinion, Chairman Bernanke, Secretary Paulson will receive A+ from history for what they did when the system started to fail. People want to critique them and second guess them and Monday morning quarterbacking them, but for those of us who were there and working through these problems, and the fact that we're here a year later, and Chairman Bernanke today said the recession looks like it's over, and most of the major financial institutions are here, and the system works. Having those men and their staffs in charge, in-touch, experienced people, was a godsend to the economy. The fifth one is liquidity matters. You hear a lot about this in the, and it's a little bit like leverage, but it's different. Again, I'd encourage you to read the papers about the Harvard and Yale endowments, but they're just the ones that get the publicity. You know, liquidity seems like a costly thing to have. Cash seems expensive when times are good. and it's priceless when times are tough. It's priceless when times are tough. Exemplified most starkly in some ways maybe by, in the Journal on Saturday, it said Harvard has changed its endowment strategic cash allocation policy from negative 5%, that is being 5% leveraged in their endowment, to positive 2%. Because liquidity matters. And it's actually causing a lot of angst, and it caused a lot of personal angst for people who bought stocks on margin and the rest. It's nice to have a little cash in the bank, or preferably in a money market fund. Finally, the last lesson that I take away, I'll share with you from the last year, and it's a worry as much as a lesson, and it's trust matters. It's trust matters. And I think about this, I thought about it over the weekend because I thought about September 11th. And we were all in the business on September 11th, 2001. And a lot of what went on in the marketplace after September 11th, 2001 took place because Bear Stearns and Vanguard trusted each other, or Goldman and Vanguard trusted each other, so we could keep the markets going a little bit, and we'd figure out the paperwork after the fact. It would not have worked. It's not a well-told story, but it's an important story. But we were able to get through that period of time because we had an inherent sense of trust. The challenge today, I think, is whether people will trust in the markets. Whether they'll trust in the markets, and whether there's a risk that we lose a generation like you guys who think a bank account is better than the risk-reward trade-offs that go on in the investment markets, or who don't trust the markets enough to want to work at firms like ours. And we need the trust of the public, and we need the trust of the regulators that the financial system, the financial participants, are trustworthy. Because the second risk inherent in that is that trust gets trumped by regulation, and that we get over-regulated in the financial markets, and that costs of capital rise, and growth rates slow. And that's a bad news story for all of us if that happens, because regulators don't trust market participants, and or consumers don't trust the markets. That's the big worry. It's a lesson and a worry. You know, all that said, to be an investor, you have to be an optimist by nature. You wouldn't invest. You think you're going to make money. I don't like short sellers, so they're naturally negative guys. So you have to be optimistic that we'll learn from these lessons and ask ourselves some questions, you know, and really just 2 or 3 that I'd end with for us to talk about. And the first is, you know, at a very macro level, does the experience of the last 12 months or 2 years, if you accept my start date, justify an entire restructuring of the financial infrastructure, regulatory infrastructure of the country? It's very debatable. The president was on Wall Street yesterday. It's a big issue, and we can all have an opinion about it. The second question that comes out of it is, and it's very topical for the kinds of things we went through, is even if you don't fundamentally restructure, does somebody need to have the whole picture in hand at all times of the sources and uses of capital in the markets because they're so big and so fast and so complex? Affectionately known as the systemic risk regulator. And then the final question, which I hope we'll talk about, is do we share, is there a risk of overreaction that will stifle innovation and capital formation? Because having been in the business for 30 years, it's been phenomenal to watch how innovation has helped all of us. And it's such simple as mortgage-backed securities making it cheaper for all of us to own a home. It gets overdone and they blow up, but securitization is a good thing. You wouldn't know it necessarily. But that's innovation. Derivatives are an innovative and good thing. Index mutual funds are an innovative and good thing. So there's a real risk, and I hope it doesn't happen, but we can talk about it, whether we think it's a reality that the regulatory pendulum will swing too far. I'll stop there. As I said, 6 lessons that to me, I know I'll repeat, because I don't want to forget them after a year or another bull market, and some questions that I hope we can have a dialogue about, and frankly, I'll look forward to questions you ask of us to hear what's on your mind so we can respond as well. Thanks very much.
Terry, do you have some comments?
I guess just the two things I'd echo. One is the question of regulation. Can you hear me up there in the back? Is that okay? Yeah. I'll just speak loud. That's fine. Sure. Yeah. And I was thinking about this on the way down. I mean, the question of regulations is really a tough one because my guess is that the three of us would all sort of say we're free marketeers. We grew up and we're successful in a free market. And I would be the first to raise my hand and say I'm against excess regulation. Having said that, it's pretty hard to look back at what happened and how we got here, and I'll try and talk about that in a minute, and say we shouldn't have had some other regulation. So, and I don't know what the answer is, I wish I had a pretty simple recommendation. It's a really, really tough question. So I think regulation is one takeaway. And the second point that I really liked was your closing point on innovation. And how do you, I think again, my guess is the three of us are all big believers in capitalism and the free markets. I was fortunate enough after graduating here to go to graduate school at Stanford in Silicon Valley in 1981 when it was just all happening, and Apple and all of the great tech companies were emerging, and that can only happen in America, and we certainly don't want to see that be stifled. What's interesting right now is in my business we're seeing banks very, very reluctant to lend. And so when people think about growing their businesses or expanding, really, really difficult to get capital from banks, which is understandable given what they've been through and how they want to shore up their balance sheets, but we need that, and we need risk capital coming back into the markets. On the positive side, what I do see, and many of you probably are seeing this as you look at job opportunities, is the whole world of distressed investing, people who have capital who are willing to put it to work to help remake bankrupt companies or troubled companies. That's again part of the rebirth of capitalism, and so that is there. But again, I think being careful not to stifle innovation is something we've really got to pay attention to.
But it's going to be, innovation may get stifled a little bit, and the pendulum may swing a little bit too far, because once you have tens of billions of dollars of government aid, if that wasn't there, it's one thing, but the United States taxpayer saved the system, and before that happens again, I think the pendulum will swing on to the other side. And I think everyone's regulatory risk, that's the new term that we're hearing a lot about. And the other thing, Jack, trust matters. It's been decimated over the last 24 months, and things won't get better again until it slowly but surely gets reestablished, and that's the goal for all of us.
Next up we have
Terry. So I'll just relay a story as listening to Jack, made me think back a year ago and how far we've kind of come, and it is amazing. I think when you stop and think, the financial system was saved. And I completely agree with you, and it has no bearing on the fact that I used to work for Hank Paulson, but I think Hank and Bernanke and Geithner, and they saved the system. And they did a lot of, probably made some mistakes, and there was no playbook, there was no binder you could pull off the shelf and say, global financial meltdown, here's what we do. But here we are a year later, and we've had a lot of pain and a lot of casualties and firms that disappeared, but we do have a functioning banking system, and that wasn't so clear a year ago. And what you made me remember is, last year our youngest went to college, and my wife and I both turned 50, and so her birthday is September 26th, and on September 27th we went to Italy for a long planned vacation, just the two of us, to kind of ease the pain of empty nesters and ease the pain of getting into turning 50. So we're in this really, really beautiful hotel.
The real pain is this kid went to Dartmouth, and that hurt, right?
I was trying to leave that out.
I know what you're saying. I recognize the shock when I see one.
But we were sitting in this really, really beautiful hotel outside of Florence, up in the hills, if you've been there, and it was this lovely, sort of Tuscan afternoon, and we're getting ready to go out for a nice dinner, and after 27 years of marriage, I realized that it was going to take my wife a little longer, and so I was watching television, and I happened to be watching CNN in Europe, and it was the House vote on the TARP, and you know, the markets were very unstable, and you know, I'm sitting there and just watching, and on CNN they show the vote, and in the corner they have the Dow, and they had some commentators, right, and they were going, well, you know, the Republicans are showing that they're displeased with this, and this is definitely going to pass, but you can see there's a very, very strong number of no votes. And you know, they kept counting, and I was looking at it and going, I don't think there's enough votes left to actually pass. And you know, the commentator comes on and says, Jane, I don't think there's enough votes left to pass. And the Dow goes down 100, down 200, down 300, down 400. And the TARP got voted down. And I remember honestly sitting there thinking, it's over. I mean, the world could be over. Let's go have a really good bottle of, you know, Italian wine, because this could be it. I mean, we laugh about it now, but about 2 weeks later, I think it was a weekend, Friday, I was talking to my partner in our investment fund, and we went into the weekend, and Goldman and Morgan Stanley had both fallen to, I think Goldman stock got down to 46. And we went into the weekend, and it was the weekend that the Japanese were going to decide whether or not to invest in Morgan Stanley. And the G7 or the G10 was meeting in Washington. And my partner and I were talking to each other, and we said, I don't know. If the Morgan Stanley investment doesn't happen, they're gone. It probably means Goldman's gone. And if we don't get some positive statement out of Washington, you know, the financial system truly, I think, could have gone off a cliff. So, you know, it's pretty amazing, again, to be here a year later and be able to look back on it. But we were really, I think, at least from my standpoint, at the precipice. So we were asked to sort of think about lessons learned, and the lesson I wanted to talk about was leverage. You know, it's true, I think, that when we look back, one of the lessons is we had an excessive amount of leverage in the financial system. And it was true on a very micro level, when we look at housing and home mortgages, and it was true on a macro level. And you know, we talk about the shadow banking system and the creation of sort of non-bank lending through hedge funds and CDOs and CLOs and SIVs. And so the amount of leverage that was in the system, as Jack said, that was one of his lessons, it was prudence. And to me, the opposite of prudence here was excessive leverage. So in preparing for today, I went back to my bookshelf and pulled out Graham and Dodd, which for any of you who are disciples of Warren Buffett, you know that Graham and Dodd is the investing Bible. My version was written in 1962. And there is a chapter in Graham and Dodd on leverage. And most of Graham and Dodd is actually about common stock security analysis. And so there is a chapter on leverage. It is chapter 48 out of 53. So as you can see, it wasn't by far the most important topic for Graham and Dodd. And they said leverage was, their definition is the use of senior fixed return securities, debt, in the capital structure. And they note stocks that are leveraged will show a more rapid increase in their value than in the total portfolio, which means that there's more rapid increase in market value than the general market. They go on to note that the principle of leverage works both ways, however. If earnings or asset values decrease, the effect on common stock is proportionally more severe. Under unfavorable conditions, the earnings power of the common can disappear entirely. And so it seems that we, as a financial system, forgot the second part of Graham and Dodd's chapter on leverage. On a micro level, it was individuals using borrowing to increase and enhance their consumption. And you know, we always were taught at Goldman, one of the great sayings was live within your means, and prudence, and sort of knowing what your spending power was. 10 years ago, the average debt per household in the United States was about $12,500. By 2007, that had doubled. 10 years ago, the average savings rate for the U.S. household was about 5% of disposable income. By 2007, it was 0. So as a result, we had over-leveraged consumers, both in the U.S. and globally. And when the economy headed into recession, consumer spending came to a screeching halt. And some consumers ended up in that second bucket described by Graham and Dodd, where their common equity, say their equity in a home, disappeared entirely. On a corporate level, companies took on enormous amounts of debt, fueled by private equity firms, fueled by banks lending, and by non-bank lending. Almost $500 billion of leveraged buyouts took place in the U.S. in 2007, fueled by almost $200 billion of bank borrowing. And as we know now, we see a rapid number of companies filing for bankruptcy in some industries, like the newspaper industry, perhaps seeing their common equity disappear entirely. And on a macro level, the amount of leverage in the financial system grew dramatically through what we have come to call the shadow banking system. And when I took money in banking here in 1978, you had banks, and banks took deposits and made loans. And since, as Jack said, we developed lots of financial innovation, much of it good, but some of it, again, going to excess. The Bank of International Settlement said in 2007 there was $43 trillion of CDS, credit default swaps, outstanding, which was roughly half of the total assets in the global banking system. We saw an explosion in CDOs, CLOs, SIVs, all vehicles designed to increase the amount of leverage in the system, and as Jack said, many of them unregulated or practically invisible to a regulator. We saw companies like AIG increasing their exposure to derivatives. And so when the economy started to slow, companies like Bear, which employed substantial amounts of leverage in their capital structure, were forced to close their doors. And it became, in essence, a run on the bank, and this enormous amount of leverage reversed itself. So the question is, what's the right amount of leverage going forward? Some leverage, some borrowing, some credit is essential to the functioning of the financial system. And I don't know the answers to these questions. And one of the things I think a lot about is when we come out of this, whenever it is, and when we return to normal, how much debt will there be? We'll still have JP Morgan and banks lending, but will we have CDOs or CLOs, or will hedge funds be lending? What's the bank's risk appetite going to be? And of course, the big question I think that we all have to think about is the federal deficit and lending and leverage and debt as it applies to the U.S. government. So the lesson that I kind of take away from the events of, as Jack said, certainly going back before, but of the past year is prudence. To his point, live within your means, use the right amount of leverage, whether it's personally, corporately, or socially, and we really need to think about what that looks like going forward and what the right amount of leverage for each of those different buckets will be going forward.
You have some comments?
I do. It's interesting. You had a little phrase at the end, the risk appetite. That is one that you worry that the appetite for risk will go away for a while. And that's a bad thing, right? Terry's point at the personally, he's talking both personally and about understanding your appetite, I think is such an important lesson for whether you're our age or a student, both with respect to career, but importantly in the markets, because our economy doesn't work without risk, and that is, we need leverage in the system. And I think that's really a very interesting challenge. The other point that was interwoven in there throughout is we lost skepticism in many ways in the markets, and healthy skepticism would reduce the amount of leverage. The surety, I said I won't name names, but Goldman is the best managed of these banks, and Goldman was exposed to AIG, but hedged on its exposure to AIG. Other people were naked to AIG because Goldman understands its risk appetite and is skeptical enough about the power of leverage, I think, fair to say, Terry, from your experience. And it's a great personal lesson if you're harder for you guys to get credit cards than it was for your predecessors, but in your own lives. But you do worry, I worry, that it's going to be harder for your clients to get to get access to the markets, and that means municipalities are going to be able to do fewer projects, and once the stimulus is over and so on. So the point is right on, and one that hopefully you guys will learn, and your generation will handle better maybe than our generation did in the last several years.
Yeah, and the Bear Stearns, which was paying the mortgage-backed CDOs, CMOs, et cetera, I mean, the pace with which these things flew out of the building was unbelievable. In our business, in municipal bonds, you can't issue them until you have a project to build. So you can't just issue billions upon billions of bonds and however that put together, and that was what was driving the growth. And in the end, they just got way too far out over their skis, and it ended. Get out of this chair if I can. I'm waiting for that.
The mic is on here, or you can use this.
So, well, good afternoon, everyone. I'm Charlie Ellinwood from Barclays Capital, and first of all, it's an honor to be here with Mr. Brennan and Mr. OToole. They kind of called me in from the bullpen here at the last minute, and I was glad to help out. But I figured out, I wondered why I was asked, and I've come to the conclusion that the reason that I am standing here today is because I'm still standing after everything that we went through. But anyway, I had quite an odyssey between March and September of 2008, and hopefully some of the things I went through you can hopefully file away and remember someday. So I'm in the municipal bond business in banking. We raise capital for states, cities, hospitals. I think even Villanova has a few bonds out here somewhere. Going back to, I'm going to speak more of March in Bear Stearns. There was a day of March 14th, 2008. And we were coming from New York, going to make a major presentation to a big state issuer in Harrisburg, Pennsylvania. And we had 6 of us on the train. We were all ready. And as you may recall, that was the morning. Things were getting a little dicey at Bear Stearns, but that's when they announced the funding package with J.P. Morgan and backed by the Fed. So I'm thinking, when I read my BlackBerry at 9 o'clock in the morning, well, I guess this is a good thing. Went on about our business of preparing to go to this presentation. I'm trying to think back, but I think the trouble started in Downingtown. On that day, Bear Stearns stock was cut in half, fell from like $60 a share to less than 30. And it seemed like every stop, from Lancaster to Mount Joy to Elizabethtown, it was going down $5 a share. I said, I got to get off this train here pretty soon. But, when we got there, you knew there was trouble. And maybe first lesson, we went into the presentation, and I said, we're not here to sell you anything. We're not here to get it. We're here, we'll talk about our ideas, things like that. But we have some issues that we have to deal with at our firm, and we probably should do that. So that was a tough weekend. Villanova had lost the day before in the Big East, so I had nothing to do that weekend. And then I remembered I had got a call on that Sunday evening from my boss. And again, remember Bear Stearns closed at roughly $30 a share. And being a bond guy, I just wasn't that plugged into how all this worked. And he said, well, Charlie, the deal is done. We're being purchased by J.P. Morgan. I said, okay. And he said, for $2 a share. I said, $2 a share? He goes, yeah. I said, as in 1, 2? This is $2 a share? He said, it's $2 a share. So here you had a stock that a few months before was at $172 a share, and where thousands and thousands of employees had their retirement and a number of investors that was now worth $2. So things were about to change in a major way. And I just have to say briefly, the next day, I mean, talk about surreal, going into 47th and Madison, you know, the news trucks are all over the place. You know, the end is near. Guys were there with their signs, and of course, it was $2 a share. People were taping $2 bills up on the window of the building, and it was, and then of course, you know, that's where the St. Patrick's Day ends, right there on Vanderbilt Place, as Terry knows, and everybody had a few cocktails, and it was made for a surreal scene. But it was done, and you know, at that point, for thousands of people, it was pretty much a giant game of musical chairs with J.P. Morgan. I happened to, you know, my counterpart at J.P. Morgan was a very talented woman who we competed against often, and she beat me more times than not, and more so she was in that chair and I wasn't. So I knew that this was probably not going to work out. So we, you know, actually the one nice thing is you get to take a couple months off to hit golf balls while they're trying to, you know, sort all this stuff out. But certainly it was, you know, fundamentally changed. So, you know, after those 3 months, and I, you know, never thought I'd have this opportunity, but and went to a firm that I had long admired, where I had many friends, which was Lehman Brothers. And, you know, who would have thunk it? But a couple months later, you know, they unfortunately met for many of the same reasons, for, you know, with the same fate. The good news of that, though, is that rather than going to the office that day in September, I was running the Villanova basketball golf outing at Canubra Country Club in Summit. We're doing it next Monday. We still have tickets, by the way, for if anybody wants to play. But, you know, it was, and then things, you know, definitely kind of came unglued. So it was, you know, where I had been well established for many, many years at Bear Stearns, as had many of my colleagues. You know, that ended quickly, and then it just, you know, had the distinction of also having it happen twice. So you don't have to, you know, once is enough, trust me on that. So since I was a late addition to the panel, unlike Jack, I don't have 6 lessons, I only have 5, because I didn't have as much time as he did. But let's quickly go through them. Number 1, when you are in a client business, never forget that their interests always come first. Never let your firm's problems be their problems. And initially, in the Bear Stearns thing, I mean, we were doing a couple major financings, and I called and basically said, how can I help you transition this, or what do you want to do? And just give them that option, because they, you know, it was starting to get a little dicey, and we felt it was the right thing to give them that option, and that it always is under any circumstances. Lesson number 2, be humble and gracious in both victory and defeat, because it's a long race. Ours is a very competitive business, and it's easy to get caught up in, and I've seen my share of you know, the financial equivalent of end zone dances when deals are getting done, et cetera. But as many people found out, I mean, the banker that or whoever that you're competing with today, you might be interviewing with tomorrow, and it's just a good life lesson that hopefully you all know here at Villanova anyway, but it bears repeating. Lesson number 3, while initially comforting, denial is not a good thing. Accept reality and move on. You know, I saw that a lot. Most cases, when your company is acquired by somebody else, they win and you lose. And I remember a lot of people who felt, well, we're better than them. We'll get this, you know. And I was like, well, okay, you can go ahead and think that. I happened to have 3 different interviews, discussions on, you know, this happened all on Monday, March 17th at Bear Stearns, and on Tuesday, March 18th. You know, you can't let the grass grow under your feet too much when that happens. Number 4, while your career is very important, try to add as much grounding and balance in your life as you can. Again, sounds fairly obvious at one level, and everyone strives for that. Not everybody attains it, and it seemed to me the people who seemed to struggle the most were the people whose lives were wrapped up in the name on their business card. And when that fell away, certainly a lot of financial security fell away too, but they didn't really know where to go and had nothing left to go back. So, you know, it's family, it's friends, it's the Villanova community, it's, you know, faith, it's outside interest, values that you've learned here. All these things come into play, and try and keep it balanced, although it's hard. And finally, lesson number 5, notwithstanding the fact that you, like everyone else, will experience some bumps in the road over the course of your career when you leave the blue and white bubble that you're in here, the fine education that you're receiving here, as well as, well, we found the support of the Villanova community for many, many years thereafter will serve you well. So that concludes my 5 lessons. I wasn't thinking a lot about Black and Scholes when I listened for the last one.
Well, Charlie says he was the pinch hitter, or the bullpen, and from my standpoint, you couldn't have a hell of a lot better than Brad Lidge right now, because one of the things that when you do what we do for a living, you can never forget it's about people. It's a people business. That story, Charlie's story, and the thousands of people, you know, and those of us who weren't at Bear Stearns and Lehman had lots of friends at Bear Stearns and Lehman, and watching the problems that occurred, it all got down to who can I call, how can I help in those things. And sometimes we talk about money and we talk about regulation and other stuff, but you know, if you come into our business in some form, make sure you sign up with the right kind of people, and if you serving, never forget that at the end of the chain somewhere is a human being. And so frankly, I think having that as the third presentation is a powerful thing, Charlie. Really powerful. And those 5 lessons.
Sorry, it had to be me.
Well, it couldn't have been better articulated nor humanizing what it is the financial business is about either.
There's I say this, I don't know if you're going to violently disagree with this or not, but there's a book about, there's many books being written about this, but there's a book about Bear, the House of Cards, which is great in 2 respects. One is it talks about the securitization of mortgages and just how that, sort of what happened. And the second is it reminds us again of one of Jack's principles of trust. And at the end of the day, banks, and certainly investment banks or securities firms like Bear Stearns, it all came down to trust. And, you know, Bear was leveraged 30-to-1, something like that, leveraged. And when all of a sudden, when, you know, people started to get concerned about some of the problems, the trust disappeared, and people just pulled their leverage. And, you know, because we've all been there, in our, you know, just remembering how firms fund themselves. And I was reading the book thinking it must have been just purely terrifying, because every day they had $10 billion in overnight repos or something, and you know, and the question was, would they roll them in the morning? And
I'll amplify that for you. I walked down my hallway on Thursday before the weekend and said, what's going on at Bear? And our analyst said, people won't roll a repo. And we didn't happen to be funding them, which was good news. But and the word he used was they don't trust that they'll get, they don't trust that they won't end up in court. And the string got pulled and it's gone.
I mean, we were, you know, to my comment a little while ago about how bad it was, we have, at my firm, we have all of our clearing business and all of our securities at Goldman. I had all of my personal financials at Goldman. And I turned to my partner on that day when Goldman stock went to 46, and I said, we better take it out, because I don't want to be the last fool standing. And they'll say, boy, he was loyal.
And poor.
And so we took out half, because, you know, we couldn't take it all out, and we went to JP Morgan, which, you know, sort of became the U.S. Treasury for a while. And, but it's just, it all came down to trust. And that's why we laughed before, but I truly believe if we had come back from that weekend and Morgan Stanley announced that they didn't get their funding, their stock would have gone to zero. There would have been a run on the bank. It probably would have gone to Goldman. And because again, one of the fundamentals of our securities business is so much of it is built on trust and overnight lending. And again, the Treasury and the Fed had to step in and provide the support when that disappeared.
Thank you so much.
One interjection, there's a new Graham and Dodd book.
Really?
Yeah, there's
An update?
an update. So it's, and the front end is a bunch of guys you know, a bunch of Seth Klarman and a bunch of, so if you're interested in a really thick book, I happen to have a kid who wears it, which is a little scary. But it's actually, if you're grab it, it's whatever it is, 60 years later, 70 years later, it's still a great piece. Terry's quote, the first 80 chapters are good too, until you, before you hit the leverage. So, sorry.
Thank you. Thank you.